Hi guys, my name is Sia Jain and welcome to another video by the ACCA Academic Blog. In today's video, I'm just going to revise the concept of IAS 23 borrowing cost with you guys. So let's get started. So when a company borrows money, they pay interest. Normally, interest is just an expense you put on a profit and loss statement, like your rent or utility bills. But sometimes interest can be treated like a cost of building something, and we add it to the asset's value. This is called capitalization. Capitalizing interest means you do not need to pay the expense now. You spread it over the life of the asset. We use IAS 23 to decide when we are allowed to do this. Now, the arguments for and against capitalizing interest, I'm just going to give you a brief summary of it. So, the arguments for capitalization: the money you borrowed is what allows you to finish the asset. If you didn't have the loan, you couldn't build it. Therefore, the interest is a necessary cost of the asset, just like the bricks and labor. We are matching the cost to the benefit. The arguments for against interest is a financing cost, not a building cost. If one company builds a factory using cash, and another builds the exact same factory using a loan, the assets will look different on the balance sheet. This hurts comparability between companies. So, like if I build my building using just my own money, and I do not pay any interest expense in it, the asset value for that building will obviously be lower. Like if 50,000, it's 50,000, so I'll just show 50,000 in my books. But if another company is building an asset using loans, so they will of course they will show 50,000, but additionally they'll show the interest expense that they have paid, like 5,000 maybe or 6,000, so that their asset value would be 56,000 or 57,000. So yeah, that's the difference between capitalization of interest. Now, the scope of IAS 23. IAS 23 applies to certain situations. We need two things to be true. We must have borrowing cost, which is the interest and related fees we pay for loans, and the loan must be related to a qualifying asset. Now, you must be wondering, what's a qualifying asset? A qualifying asset is anything that takes a long time to get ready to be used or sold. That think brick projects like a new factory or a huge ship that takes years to build. These are our qualified assets. Definition of borrowing cost. What counts as borrowing cost? It is more than just a simple interest you pay. It includes the interest expense calculated using the proper financial method. It also includes other charges, the fees you pay to set up the loan, or the extra cost, the premium you pay when you pay back the loan. These extra costs are all part of the price of the borrowing money. So you can also include these costs or these expenses as an asset in your statements. Now, recognition of borrowing cost. This is the golden rule. If borrowing costs are related to a qualifying asset, you must capitalize them, add them to the asset's value. And if these costs are not for a qualifying asset, or if the asset is finished, then these costs are treated as a regular interest expense in the profit or loss statement. Now, if it is a qualifying asset, it is compulsory. It is not an option. It is compulsory that you add these expenses in your assets. But if the project is finished, if the building is finished, and your loan is still outstanding, you cannot include these costs in your asset value. You need to then expense it into your profit and loss statement. uh, Disclosure of, sorry guys, 1 second. Disclosure of capitalized borrowing cost. The notes to the financial statement should disclose the amount of borrowing cost capitalized in the period and the capitalization rate issued. So the notes which we write to the financial statement should include the capitalization rate which we used for calculating our interest expense, the amount of borrowing cost we also capitalized using the capitalization rate. Qualifying as assets. Sorry guys for the disturbance. Borrowing cost directly attributable to the acquisition, construction, or production of a qualifying asset must be capitalized as part of the cost of that asset. Now, the examples of costs which we can include in qualifying assets are inventories which require a substantial period of time to bring them to a saleable condition, manufacturing plants, power generation facilities, investment properties. Example of assets which we do not qualify: inventories that are routinely manufactured or otherwise produced in large quantities on a repetitive basis over a short period of time, and assets ready for the intended use or sale when acquired. So, in general, the assets which take a short which sorry assets which take a short period of time to get ready, we do not capitalize these costs as an asset. And when we buy a building and it's already in a saleable condition, we can use it or sell it as it is, then we cannot capitalize that interest expense in our assets. And which we can qualify is our inventories that take a long time period to get ready, and a large assets like building something, a manufacturing plant, etc. These interest expenses can be qualified. Now, borrowing cost eligible for capitalization. Specific borrowings. When an entity borrows funds specially to obtain a qualifying asset, the identification of the borrowing cost is straightforward. The amount capitalized in the actual borrowing cost incurred during the capitalization period, less any income earned on the temporary investment of those borrowings they are used. So, okay. So now imagine you took a 10 million loan. Okay. It's maybe you didn't use that 10 million loan entirely on the asset. You use 6 million of it and you're paying 6,000 or 6,000 as an interest, and the remaining 4 million you use it in another investment or anything else, and you're gaining an income of 4,000 from it. So you cannot capitalize the whole 6 million as an asset. You can only you need to minus that 6,000 4,000 from that 6,000, and only you can capitalize your 2,000 remaining amount. Funds borrowed generally. The amount of borrowing cost eligible for capitalization is determined by applying a capitalization rate to the expenditure of that asset. The capitalization rate is a weighted average borrowing cost applicable to all borrowings that are outstanding during the period. This excludes specific borrowings until such time as the asset that is being funded by the specific borrowings is ready for use or sale. The amount capitalized during a period cannot exceed the amount incurred. In some circumstances, it is appropriate to include all borrowings of the parent and subsidiaries when computing a weighted average borrowing cost. In other cases, each subsidiary may use its own weighted average cost. So now let's see an example. Okay. So sometimes it may be that you take different loans to fund one asset, like building an asset is a very big expenditure. So sometimes you take multiple loans. So how do we find out an uh, rate of interest which we should use to capitalize our interest expenses? So let's see how they do it. So an entity has three resources of borrowing in the period: 7-year loan, to 25-year loan, and a bank overdraft. And these are our loans, and these are the interest expenses which we have paid. Sorry, I am using a laptop, so my drawing may be bad. So what we have to do, it is easy. The formula is very simple. We just use these interest expenses as our numerator, and these loan amounts as a denominator, and we just find out a simple average percentage of these. So let's see how they did it. Oh, sorry. So yeah, to calculate the appropriate capitalization rate if all the borrowings are used to finance the production of a qualifying assets, but none relate to a specific qualifying asset. So yeah, we are using all of these loans to fund one of our asset. So what we are going to do is just take these interest amounts over here as our numerator and these loan amounts as our denominator, and find out an appropriate percentage. And the second scenario, oh sorry, these drawings. Just give me 1 second. Uh, yeah. So if the 7-year loan is an amount which can be used specifically identified with the qualifying asset, calculate the rate which should be used for the used on the other asset. So we do not need to count this 7-year loan. We are just going to use this 25-year loan amount in the bank overdraft. Again, it's very simple. We use a 1,000 and a 6,000, and just divided by the 12,000 amount and the 4,000, and we get a percentage. Sorry. Yeah. So let's move forward. Now, when do we commence capitalize our interest expenses as an asset? So capitalization commences when expenditure on the asset is being incurred, borrowing costs are being incurred, and activities necessary to prepare the asset for its intended use or sale have started. IAS 23 identifies which activities are relevant when determining whether to commence capitalization. Activities include physical construction of the asset, technical and administrative work before physical construction commences, and activities excluded, holding an asset when there is no production or development that charges its condition. For now, let's see. So you do not just start capitalizing the interest expense as soon as you borrow the loan. You there's something, the expenditure should be made on an asset. You're using that loan to fund the asset building, and borrowing costs are being incurred, and the necessary steps to prepare the asset or for its intended use or sale have started. You're actively making some steps, some movements to build your asset. Then you can start the capitalization of your interest amount. So yeah, the activities which are included is the physical construction of the asset. You're physically building the asset and it's the process has started. Then you can commence the capitalization. Some work is being carried out even before, if you have not physically started some work, some research work or technical administrative work. You're conducting some work related to the asset, then only you can start the capitalization. But if you're just holding the asset, like you have commenced the building, physical construction of a building, you have you have actively made some contribution for 3 months, but after which you hit a rock bottom, you hit something happens, and you have to stop that process. Then you cannot capitalize the interest expense for that much period. Suspension of capitalization. Capitalization should be suspended during extended periods in which active development is interrupted. However, capitalization is not normally suspended during a period when substantial technical and administrative work is being carried out, or when a temporary delay is a necessary part of the process of preparing an asset for its intended use or sale. So, let's see. If that's what I stated earlier, you have to suspend a capitalization when you're not actively doing something or contributing something to build your asset. Then you cannot capitalize those interest amounts. If if you have stopped performing your work, then the for that time period at least you cannot capitalize your interest expenses. Cessation of capitalization. Capitalization ceases when substantially all the activities necessary to prepare the calling for asset for its intended use or sale are completed. An asset is normally ready for its intended use or sale when its technical construction is complete, even though routine administrative work might still continue. If only minor modifications are outstanding, example, interior decoration of a property to the purchaser or user specification, this indicates that substantially all the activities are complete. When a construction is completed in part, each part is usable while construction continues on another part. Example, construction on a business park with many buildings. Capitalization of each part ceases when substantially all the activities necessary to prepare it for its use are completed. So, when do we cease the capitalization? When do we stop capitalizing the interest amount? It doesn't matter if your building is done in May, but you do not pay the loan until September. You cannot capitalize the amount for June, July, August. You need to expense it off your profit and loss statement once your asset is complete. We do not include minor modifications which we need to make. We do not include that period. If it's proper, it's ready, you can use it, you can sell it, then your asset is complete, we consider it complete, and you need to stop capitalization of that till that period. And if you're completing your construction in small parts, like you have first built the first floor, second floor, something like that, if your first floor is complete, you cannot capitalize that amount also. You need to cease capitalization for that too. So yeah, that was our IAS 23 borrowing cost. I'll just prepare a small timeline so you can know when do we start. It's just a brief summary. So yeah, so this is a line. So now when you borrowed this is where you borrowed the loan. Now you cannot just start recognizing these interest expense. Maybe you borrowed the loan in January. Okay, now you cannot just start recognizing this as an asset until you're making some active contributions to your building or your asset. So we start making our building till from February. So you can just start capitalizing your interest expense from February. Now maybe in April something happened and we had to stop our construction for a while. So from April to, let's say, June. Okay. So from April to June, you cannot recognize this as an interest asset, the interest expense, and you need to qualify expense it off to your profit and loss statement. Again, after June, you started actively making some contributions, and again the process is started. So sorry guys, just 1 second. Yeah, so from June you have started making some contributions again. So let's what happened? I guess I lost the drawing feature. Yeah, so from June you made some contributions again till September, and then your building is complete. In September, your building is complete. Then you need to stop capitalization of the interest expense, and until you pay the loan, that interest expense will be expensed to your profit and loss statement. So yeah, that's it, guys. IS 23. It's very simple and basic. You just need to concentrate a little bit, and the concept will be much more clearer to you. Thank you so much for watching.